Logan here with Digital Finance Weekly. My message this week, guys, is relax. I have not seen this much fear in the markets and in media, really, since early summer with kind of those major crypto declines. Between Evergrande, debt ceiling issues, other things that need to kind of be passed through government this month, there's a lot on our plate that kind of needs to go right in order for markets to continue to move upwards. What I want to talk about today, guys, is what is that worst case scenario? Because we're all feeling a lot of fear right now, but what's the worst that could happen? People are comparing Evergrande to Lehman. I think that's a bad comparison. Lehman Brothers was a $600 billion debt bubble when our economy was a lot smaller relative to what it is today. And that was kind of a rumor on the Sunday night before the Monday morning when they officially defaulted and the economy crashed. We are publicly talking about Evergrande. We have actually been for a while. And it's hard to imagine that central banks and other players aren't planning to navigate that kind of a crisis, that kind of risk. So I don't think it's that big of a deal. But suppose some of these other issues or Evergrande really does sink the market. Let's go back to March of last year. We had the sharpest sell-off in the stock market, I believe, in history. And the Fed and the US government basically printed and stimulated our economy out of it within about 2 months, guys. So, and what happened as a result? Asset prices went crazy because, of course, we printed over $10 trillion. And, asset prices perform really well in that kind of environment. So let me remind you guys, let's relax but prepare. So always have a number of months of cash on hand to just get by in life, right? Pay the bills. So if asset prices fall, you don't get caught at selling at the bottom, because that's when life changes. That's when we really face some pain throughout all of this. In fact, you might want some additional cash to be able to buy a bottom, buy some call options or something at the bottom there. But really, worst case scenario that I can see is that asset prices drop by 50%. We print money, and within 3 months, by December, we're already back on our feet and ready for the economy to roar because we have stimulated it to oblivion. So short term and medium term, guys, there is, in my opinion, very little risk of us all sort of just like losing all of our money, which seems to be what everyone is really freaked out about at the moment, is just this massive economic catastrophe that sticks with us for years. I don't see it. I don't see that possibility. Not when the US has the money printer and 80% of transactions are done in the US dollar. They're going to use it. What I will say, though, guys, is if we do see an event like that, it's not that it's risk-free. It's just that risk is really kind of delayed down the road. So as many of you guys know, a lot of you guys are even more savvy in the realm of finance than I am. There's sort of a diminishing returns effect to money printing. And so when you print $10 trillion today to stimulate the economy, that's going to have a pretty grand effect. But suppose we have done that 4 times already. When you print that next $10 trillion, it's going to do less for you because your level of debt is, the proportion of that stimulus relative to your debt is it's a way different proportion. And so you need to print more and more and more money. And so my point, guys, is that the risk is being delayed in that the global debt crisis that is kind of coming. It's kind of why a lot of us got into Bitcoin, buy gold, these things to make sure that we are protected in case the financial system cannot, be supported years down the road, which I believe is probably the case, but I do believe it's years down the road. It could increase volatility in the markets and then kind of reduce the timeline for when that last major global debt bubble could pop and we get a global recession where we simply can't print our way out of it. Currencies have been kind of printed to oblivion. And we'll see where it goes. This is even a hypothetical. We have so much deflation in the system. There's a lot of arguments going on that we couldn't even get hyperinflation because of AI and robotics and all these crazy, if anyone is in crypto space, I'm invested in Wilder World. They're basically remaking the global economy and remaking a sovereign state in cyberspace. It's insane. So there might be so much deflation that hyperinflation is almost impossible. But yeah, so I guess my point, guys, is if you're worried about the next few months, if you're worried about this bull run, I would take a deep breath and relax. Make sure that you guys are set up with some cash for the next few months. But just in case the worst happens. But if the worst does happen, all that means is that you're going to be really happy that you own some assets and that you're going to be able to ride the next leg up in both stock market and crypto. So hope you guys enjoyed the video, and I'll see you next time. Thanks.